Right then, good afternoon folks, and just another update from us at the end of another boring week of markets. I'll jump onto the calendar, a quick flick across the calendar, which what we'd hoped to be a bit of excitement on Wednesday at 1:30, which again, the numbers you can see here on the screen, pretty bang in line with expectations. You can see consensus for the core CPI print year-over-year figure, bang in line with consensus. You can see the month-over-month figure, bang in line with consensus, still rising at 0.4%, which is slightly too high for the central banks to be able to tolerate. You can see the inflation rate, the headline print, the year-over-year figure, consensus 5%, actual 4.9%, so slightly lower than anticipated, which continues this downward trend that we can see on the CPI prints over the course of the last year. But that is a little bit tricky to navigate, right? I see so some market participants believing that the Fed will now go on pause after this, but it was an 8.5% inflation print this month of last year. Right, 8.5% last year. So this 4.9%, take into account that it is a yearly figure, it is 4.9% higher than the 8.5% print that we got last year. So 8.5 plus 5% is what? 13.5%. So once you do the maths and then adjust the two of them together, it's probably 15% inflation, maybe over 15% inflation from this month 2 years ago, which is massively high. So yes, we are trending lower at the moment, which is great. Some market participants believing that the Fed will go on pause at the next, will go on pause now after the last meeting. I'm not so sure. Rate of inflation still too high, not coming down as fast as they would want it to, and they've still got more work to do, in my opinion. Which has kind of been relayed in markets. Once we come across the charts in a minute, and we'll have a look. We'll get back to that in a second. But it certainly is a sticky situation. Not the progress that we would like to see in terms of cooling down inflation. You can see the Bank of England then on Thursday of this week, a 25 basis point hike, pretty in line with, or not pretty in line, bang in line with expectations. A 7-2 vote split, again in line with expectations. Turn right around, ding being the dissenters, again suggesting that the interest rates are okay and they need to let what they have already done continue to take effect and then reevaluate in the coming weeks or months ahead. But I still need to keep hiking interest rates. The last CPI print came in 10.4% in the UK, and that would suggest that they need to continue hiking interest rates. Markets currently price a further 25 basis point hike, and then they said we'll see. They're saying that we will see after that. The central bank have left the door open to further rate hikes, and that's what you would probably expect at the next meeting, a further 25 basis points. There was upgrades to CPI, there was upgrades to GDP. The central bank no longer forecast the UK economy to enter a recession, which had been forecasted by a number of market participants over the last number of months. But upgraded CPI forecast, that's potentially the reason for some downside in the aftermath. We'll jump over some charts and we'll have a quick look at that as well. You can see GDP figures then out over the course of this morning, 7 a.m. this morning. You can see the month-over-month figure as the March figure in terms of the UK, and is minus 0.3%. But the important one, the quarter-over-quarter figure, the preliminary figure, consensus for plus 0.1, actual plus 0.1. So not exactly strong growth, but it does avoid the negative print, which obviously you need two in a row to consider it a technical recession. You got some Michigan consumer sentiment figures out in about 40 minutes time, as you can see on that. And there's a couple of medium impact numbers that I think may be worth paying attention to. Maybe a couple of low impact numbers. We'll have to get back to this. Scroll all the way down again. Where are we at? So Michigan inflation expectations is probably one to keep an eye on. 3 o'clock today. What the university think in terms of inflation going forward, where they think that will be sat. Any beat or miss in that, probably to gather some attention, even though on this calendar it is a low impact data release. Right, over to the charts, and you can see what you can see across these charts is obviously some upside then off the back of the US dollar. You can see the slight miss on expectations. You can see here on Wednesday at 1 o'clock, or the 1 o'clock candlestick, which includes the 1:30 data release, had a solid bit of downside, right, but that's quickly completely reversed and started pushing higher again. Probably the algorithm sending it short, and then people coming to their senses, slightly seeing that inflation is still far too high. It's not coming down the way they would hope, and that has then rallied higher, which goes against what we were hoping for last week. You can see then a spike higher off the Bank of England then on cable. Right, solid bit of upside then across cable, which then has turned around and then started pushing back lower again. Off the back of a bit of dollar strength, but also off the back of the fact that the central bank in the UK are probably going to need to hike interest rates further and further, and they're not getting a hold of inflation. Inflation's still at double digits, and there's just kind of general problems within the UK economy. For me personally, okay, the updated growth forecast, and not expect to enter a recession, which is a positive, but if they have to keep hiking interest rates and inflation doesn't budge, they're only going to do one thing, or have to do one thing, and that is hike the economy into recession, which is obviously not what they would like to do. Euro dollar continues to push lower, obviously in line with dollar strength, but euro dollar continues to push lower. Contributing factor to that, we got on Monday, you can see industrial production out of the Eurozone, which is the largest print in over a year, largest negative print in over a year. Minus 1.3% was the consensus on that. Minus 3.4 is what we got. And obviously industrial production is a large component of the European economy. Obviously Germany is then the largest economy within the European economy. Contributing factor to that, plus the inflation situation in the US, expectations for more hikes when the door was potentially open to stop hiking interest rates. That would be my thesis on the moves over the course of this week. And the S&P not really participating. It has not budged really since the 31st of March. The 29-30, there was a run up to this, and we just kind of chopped sideways. So trades that we were hoping for over the course of last week haven't really played out, but we were hoping for a lower than expected inflation print, which is not what we got. Right, so kind of puts that idea on hold. But I think this level on the dollar index that we're testing now, you can see these number of touches back here that we have pushed higher up into today over the course of yesterday and today. I think that is an important level. If we can get above there and get above 102.50, I think it opens up some scope for some further upside. As long as we are below there, there's a good trade to be had below 101 if we can get there. But I think a pop higher and a retest of 102.50 might be the way to play it now. Euro dollar's not really got any significant levels to the downside. There's a bit of a level at 108, but apart from that, not really a great deal to see on euro dollar until you're down to 105.30. Now the S&P struggling to break these highs up here. The dollar continues to push higher. It should prove negative for the S&P 500. So a little bit more difficult now that it's gone the other way. I was hoping for it to the dollar index to break lower, euro dollar to continue higher, S&P to break higher with it, and those bond yields to break through that level to the downside. But we'll flick up the 10-year yield as well, and you can see at this level we were looking at last week. Stick it on the weekly time frame. The level that we were looking at last week has failed to break again. Right, we're just kind of chopping sideways. We've been chopping sideways since the 20th of March. Really not a great deal to see across the major asset classes. We are waiting for some direction one way or another, which we just have not got yet. We'll come across the next week. Have a quick flick across the calendar. You can see some figures out here on Tuesday, some labour market figures out of the UK. Well, you can keep an eye on the labour market. They're going to need the labour market to loosen up a bit and unemployment rate to rise a little bit in order to help with that inflation situation. So I think print of 4% on the unemployment rate will actually not be too displeasing for the Bank of England. Across some other figures, if you're a trader of the Canadian dollar inflation rate, as that continues with the Bank of Canada on pause as we speak, not looking to hike interest rates any further. If that continues to push lower, below consensus and miss consensus, that may be a reason to sell the Canadian dollar off the back of the central bank not looking at rate hikes anymore. But a pretty quiet economic calendar, as you can see. Next week, got a speech out of Jerome Powell next week at 4 o'clock, but you'll hear from us again before that. Apart from that, not really a great deal to go off next week. You can look towards your charts, look towards your cross-asset correlations, and just see how markets move. After the last few weeks, though, I wouldn't be too hopeful of some massive moves, but maybe that's when you do actually get one. That's it from me then, folks. Gonna wrap it up there. Have a nice weekend. Do recharge the batteries, and we will be back next week for another week of trading. Thank you.